Sir, thank you for pointing out what should be the right temperament for an investor who is investing into a global trading firm such as yours or a fund such as yours, especially during these times of drawdown or periods of underperformance. What is the psyche on the other side? What is your firm's approach? Is there any firefighting that you do? Is there any review that you do? Or is it just a part of business, a cycle that you allow it to pass through?
See, as you mentioned before as well, right? For us, everything that we try to do, we try to make sure that machines are taking most of the decisions, and we as a human are just putting all intelligence in the machine only, right? Even in these kind of scenarios, right? Whatever we learned in the past and whatever we are observing currently, we try to put our learning in the machine and let machine highlight what might be the problem. So let me give you an example. See, let's say if I'm trading in a number of markets, right? And every strategy has, for some reason, lost very small amount of money, but they lost it together. And it was a very, very small per strategy amount, right? It's like it's not even 1% of the risk that strategy is taking. But for some reason, it all happened together, and the round happened. Right? In these scenarios, we typically don't overreact. We let machine run as it is, because what we believe that too much manual intervention over the top of machine hardly adds value. But now let's say in another scenarios, let's say something structurally changed. Let's say in India, some months back they increased the STT, right? Stamped STT tax on futures market, right? We used to do a lot of stock futures intraday models, and suddenly some of the high churn models in which we used to trade multiple times in a day, their performance started deteriorating. Why? Because of increase in STT, the bid-ask spread got widened, so our slippage is increased, our cost doubled, right? So in these kind of scenarios, when we see the drawdowns are coming for some structural changes, or if we believe drawdowns are happening because certain changes happen in that market for long term, right? That's where we try to change things. We've taken a stance at that moment only that will focus more on durations in Indian stock futures. We will not stop playing Indian stock futures, but we'll play more duration. We'll reduce the allocation to stocks future strategies which are lower duration, and we'll increase to the higher durations. So these are the things that sometimes manually we have to put into the system when we believe there's a structural change. We don't want machine to take n number of days or n number of months to learn it, because, and let's say one more thing that I want to add here, right? And it's good that you pointed out, right? One thing that we have observed, right, with one change that has happened in the market a lot is the markets change their cycle too fast. There was a time when market was a slow moving beast. Now it's a very fast moving, still a beast. It was always a beast, still a beast, but it's become from a slow moving beast to a very fast moving beast because of all kinds of technology, all kinds of data availability, all kinds of information disseminations. People react very fast, news travel very fast. So now what you have learned, right? Everything has to go to the adaptive. So every strategy, obviously most of our strategies learn automatically. They try to learn their parameters dynamically as per the market environment. But this adaptiveness of our strategies, the investment, the research behind them have gone multiple fold from our side. That everything that we are doing need to be a lot more agile, need to be a lot more adaptive, because we know the market cycles are changing too fast, the rules are changing too fast, the market structures are changing too fast. Give you another example. China recently made a rule where they just say no collocation. It's just removed collocation.
Oh.
Right? So now and I think, just give you another example, the structural changes, right? Something you've never heard of in your life. Not in 2025, dollar depreciated 10 to 11% in the year. The dollar itself depreciated against all major currency 10-11% in a year, but still USD had a worst year. So our INR further depreciated against a depreciating currency by another 5%. Right? These are the things are unheard of. Where dollar is depreciating and still INR is depreciating. These are the things that never happen in the market. So markets now changes their structure very fast. Things which never used to happen will happen in months now. So even if we become hyper vigilant as an individuals and try to put all the learnings manually in these machines, it will never happen. So now a lot of focus have gone from our side into making our machines more agile, more adaptive. Strategies which were a lot more static in nature, we are slowly moving them out of our production systems and taking back to the back testing and make them more agile and more adaptive, because that's the only way to solve it. Only way to solve and figure out to best see that okay, this drawdown is avoidable or this drawdown we should react in certain way is machine doing it. Put any human intervention in avoiding drawdown or overreacting during a drawdown will always have a negative consequence. So for us, everything boils down to how to make machine more intelligent, how to make sure that most of our, or almost all our decisions are coming from machine.
Okay, so the key takeaway for our clients/investors is that markets are changing rapidly, and the way global quant trading firms such as 26 Miles Capital are working continuously to make their mathematical models more adaptive to these changes with very less human intervention.